Imagine this. Last year, the largest banks on the planet made more than $142 billion in pure profit. That's not revenue, that's profit. They didn't create a game-changing phone. They didn't build cars or rockets. All they did was move money around. And guess what? You played a part. Your checking account, your savings, even your credit card swipe. And you may not even realize it, but it all fed into that massive number. So how do they turn your everyday financial actions into billions? What's their secret? That's what we're uncovering today. We're going behind the scenes to reveal how banks actually make money and how you can use that knowledge to your advantage. And if you find this eye-opening, please subscribe, but only if this is truly interesting and useful to you. Let's dive in. There are four main pillars that banks rely on to make money. Net interest margin, the difference between what they pay you on deposits and what they charge others. Fees and service charges, those little penalties and account costs you might not even notice. Investment banking and trading, Wall Street style, IPOs, mergers, and proprietary trading. Other income streams, including wealth management, FX spreads, securitization, and insurance. Each pillar plays a strategic role. Let's break them down, starting with the foundation. Picture this. You save $10,000 in a savings account. The bank pays you 1% interest. That's $100 after a year. But here's the secret. They lend your money to someone else at 6% interest. You earn $100. They collect $600. That $500 difference? That's called the net interest margin, or NIM. This is core to banking because it creates predictable, consistent income through fractional reserve lending. Fractional reserve means banks keep only a small percentage in reserves, lending out the rest. This maximizes their lending capacity and their profits. In 2024, U.S. banks generated over $250 billion in net interest income. It remains their most stable and powerful revenue stream, even in volatile markets. If you're learning something new already, drop a like so YouTube shows it to more people. Here's why banks love net interest margin. It's scalable. More deposits mean more loans. It's asymmetrical. They're great at widening the interest gap. When central banks raise rates, banks typically boost lending rates faster than they increase deposit rates, widening margins. That's why in many economic environments, higher rates equals higher profits for banks, even if it costs savers more. Now, let's talk about fees. These are subtle but powerful. Common ones include $30 overdraft fees, $10 to $15 monthly maintenance, $3 ATM fees, $25 to $35 wire transfer fees, $2 for paper statements or duplicate checks. These may seem trivial until you realize banks made around $34 billion in fees in a single year. That's money most people don't even notice. And banks design account structures to generate these fees. Low balances, short grace periods, lazy alerts. Examples. You miss the $1,500 minimum balance by $10. Boom, $12 fee. You're 2 cents overdrawn, and that's another $30. It's small, but it triggers massively profitable behavior. If you're paying fees, it's not your money, it's theirs. Compare checking account options. High-yield online options often have no fees. Traditional branches, they rely heavily on penalty income. So ask yourself, how often have fees eaten away of your balance without you realizing it? Now let's hit Wall Street, where the real fireworks happen. Investment banking includes advising on IPOs and M&As, underwriting public offerings, proprietary trading, take an IPO. If a company raises $2 billion and the bank takes just 5%, that's $100 million. That's real money. Then there's trading. Banks buy and sell currencies, stocks, bonds, commodities. Some trades are for clients, others are their own capital, proprietary trades. In 2024, global trading and investment banking revenues totaled over $120 billion. It's high risk, high reward, and banks aggressively pursue it. This isn't just flashy Wall Street hype. It sustains growth. Trading profit supports global operations, success attracts top-tier talent, it funds innovation, and lowers costs elsewhere. It also creates cycles. Good years fuel more growth. Bad ones stifle it. Understand this risk for risk and return perspective. Ask yourself, what if your bank said, let us manage your $100,000 for a small fee? That fee, typically 1 to 2% per year, pays them $1,000 to $2,000 annually, even if your investment does nothing. Now multiply that by thousands or millions of clients. That's recurring, predictable income. Add mutual fund fees and commissions, and wealth management becomes one of banking's most recession-resistant sectors. Benefits for banks: cash flow stability, deep client trust equals cross-sells, assets under management equals marketing tool. But clients should know, high fees sometimes eat into returns. Check performance after fees to evaluate real value. Banks make money in less obvious ways. Foreign exchange spreads when you travel abroad and exchange money. Securitization, packaging mortgages into bonds and selling them. Loan servicing fees, collecting payments, even on loans they no longer own. Insurance commissions, selling credit life, protection, and small business coverage. These may not be blockbuster, but they're reliable and they diversify income. FX example: converting dollars to euros. Their exchange rate is always slightly worse than the mid-market. That spread is pure profit. Securitization: they bundle your loan into a type of bond, sell it, and might still service it, earning structuring and servicing fees. This frees up capital and generates revenue. None of this is free or easy. Banks face loan defaults, 24 months of unemployment, boom, they lose money. Regulatory burdens: after 2008, banks were forced to hold more capital, reducing potential returns. Rate environments: low rates compress margins. High rates slow borrowing. Fintech competition: digital banks and neobanks lure away customers with better deals. They're constantly balancing growth and compliance. They manage risk through stress tests, diversified portfolios, hedging strategies, and emergency liquidity reserves. They also lobby strongly for favorable regulation, and sometimes receive government assistance. It's complex and very tightly regulated. Let's examine JP Morgan Chase in 2024. 60% net interest income, 20% trading and investment banking, 10% wealth management, 10% fees and other. This split shows core reliance on lending, bold expansion in deals and trading, supplemented by stable, smaller lines. This diversified model gives resilience and insight into how big banks think about profits and risk. Let's take a deeper look at something called securitization, one of the most powerful tools in modern banking, and honestly, one of the least understood. Securitization is when a bank takes a bunch of loans, like mortgages, student loans, or even car loans, and bundles them into something new, a security. Then they sell it to investors. Here's a simplified version. You get a mortgage from Bank A, but instead of holding onto that mortgage for 30 years, Bank A sells it. Your loan gets bundled together with hundreds or even thousands of other loans into a single financial product. That product is sold to investors, who now get your monthly payments. And the bank? They take a cut right off the top. This is securitization. And here's why banks love it: liquidity. Selling loans brings in cash, which they can lend out again. Fee income. They earn money from originating, bundling, and servicing those loans. Risk transfer. Instead of holding risky debt, they pass it off to investors. It's smart, it's efficient, and it's incredibly profitable. But there's another side to this. If there's high investor demand for auto loan securities, guess what? Banks push out more auto loans. Same with student debt, credit cards, you name it. They're not just meeting demand, they're feeding a global investment machine. And here's where things can go wrong. Remember 2008? Banks were packaging risky subprime mortgages into these securities, and when people couldn't pay, the whole system crumbled. So yeah, securitization can work, but it can also amplify risk when the loans behind those bonds start falling apart. Now you know, if you've got a mortgage, it's probably been sold. Not once, maybe twice. Your loan? It's a product. Bought, sold, sliced, and repackaged. And the bank? They've already been paid. Let's zoom out for a second, because one of the biggest profit levers for banks, it's not a product or a fee, it's interest rates. When central banks raise or lower interest rates, they don't just affect your mortgage or your credit card. They shift the entire income structure of the banking system. Here's how. When rates go up, banks charge more for loans, but they're slow to raise the rate they pay you on deposits. That difference? You guessed it, net interest margin gets wider. Let's say they were paying you 1% and charging 5%. After a rate hike, they're still paying you 1.5%, but now charging 7%. Boom! Bigger spread, bigger profits. But that's not the full picture. If rates go too high, people borrow less. Mortgages slow down, credit card balances shrink. Loan volume drops. Defaults rise. Profits shrink again. Now reverse that. In a low-rate environment, borrowing skyrockets. But margins? They're razor thin. So even though more loans are going out, each one makes less money. To compensate, banks lean harder into fees, trading, or securitization to protect their earnings. It's a balancing act. And banks are masters at playing both sides of the rate cycle. When rates rise, they grow margins. When rates fall, they chase volume and diversify revenue. But understanding this helps you as a customer too. For example, if savings account rates aren't going up with the Fed rate hikes, you know the bank is widening that spread. If banks start offering crazy loan deals during low rate times, that's them chasing volume over margin. Bottom line, interest rates are the invisible engine behind every banking decision. They dictate when to lend, what to charge, and how to earn. Now, the next time you hear the Fed just raised rates, you'll know it's not just news. It's a trigger for how banks profit next. So what now? 3 practical steps. Get smarter on savings and loans. Shop online banks for better rates. Consider peer-to-peer platforms for borrowing. Use auto sweep or link features to avoid overdrafts. Ban fees from your life. Evaluate your checking account thoroughly. Switch to fee-free accounts. Use notifications to stay ahead of account thresholds. Scrutinize financial advice. Is the product in your best interest or theirs? Ask about conflicts of interest. Get second opinions on big decisions. With knowledge comes power. You can't erase bank influence, but you can get smarter. Here's the bottom line. Banks built a powerful money machine using interest spreads, fees, trades. They profit on nearly every step of your financial journey. Now that you know how and why, you can take action. Save smarter, avoid fees, question advice. Stay true to your financial goals. If this video opened your eyes, please like and subscribe for more deep dives into how money really works. Leave a comment below. What's the most annoying bank fee you've ever paid? Thanks for watching. This is BytePlain, and I'll see you in the next one.